Welcome to The Healthy Advisor, a podcast from wealthmanagement.com focused on advisors' personal well-being and healing. I'm Diana Britton, managing editor of wealthmanagement.com, and in this podcast we explore some of the struggles and personal development issues facing advisors and financial services professionals, and how to get to a place of healing for mind, body, and spirit. Hello, and welcome to the latest episode of the Healthy Advisor podcast, and thanks for joining us. As you may know, this is the podcast focused on financial health and well-being, and today's guest has been studying this very topic for the last several years. His name is Michael Kitces, blogger, chief financial planning nerd at kitces.com, head of planning strategy at Focus Partners Wealth. He's also the co-founder of the XY Planning Network, Advice Pay, New Planner Recruiting, FP Pathfinder, and FA Bean Counters. He also hosts the Financial Advisor Success podcast, a great, wonderful podcast for the advisor population in general. Please go and listen to it. Michael, thank you so much for being on the podcast for the second time.
My pleasure, Diana. Appreciate the opportunity to come in and get to talk more about all things advisor well-being.
Yeah, so that's exactly what we're going to dive into today is the results of Kitces Research's 2025 Advisor Wellbeing Study. You know, this is a little bit different from other podcasts I do where guests come on and talk about very serious, deep personal issues that they're going through. And we're going to just dig into some numbers and facts and figures about advisor happiness. I mean, you know, the industry has all these practice management benchmark studies for the financial health of an advisory firm. But, you know, Michael and his team, you know, are really inspired to look at the health, the well-being of advisors themselves. And that totally makes sense to me. Just big reason I have this podcast. And so, yeah, I wanted to touch on one kind of the major finding, Michael, was that the well-being rating was 7.3, up about 7% from 2023. And, I know you surveyed nearly 1,500 members of financial advisory teams on their current level of life quality based on this 0 to 10 scale. So that's kind of what we're looking at. And I know that past reports found that advisor well-being was roughly on par with the U.S. population. The 2025 survey found that it was higher than the broader population. So what do you think is driving that improvement in advisor well-being? Can we start there?
I think there are a few drivers of this, and we've been doing this study since 2021, where we were actually collecting data at the end of 2020, so kind of right in the midst of COVID back at the time. And so we ended up unwittingly getting to chart how COVID and all the downstream impacts of COVID rippled through the advisor world. And there are a few things that we found in following that journey. The first that was striking is, if you go even further back in our data, our well-being in our 2023 study was actually worse than 2021. What we found was that the disruptions of COVID, certainly for all of us going through it in our lives with our families, was very dramatic in real time. The advisor impact showed up a lot more 2 years later, which we find was when firms really had to then figure out how they were operating in this new world, often in a more digital and remote environments, right? If you go back to 2023, some firms had returned to office, some had not. Some were not thrilled about returning to office, even though they had. Some had team members that were fighting return to office. And so work environments were very disrupted. And a lot of the data that we collected around advisor satisfaction with their work environment is very mixed in 2023. What we find now in 2025 that seems to be lifting overall sentiment, at least back to where we were 4 or 5 years ago, is that a lot of our workplace disruptions have kind of sorted themselves out. I mean, for better or worse, if you're at a remote firm now, it's a remote firm. If you're at an in-person firm, it's an in-person firm. If you're at a firm that's got some kind of hybrid, flexible work environment, they've largely figured that out. And so as work environment stabilized, we see a lift in well-being. I do
Mm.
think the second part that probably goes along at least lightly with this is we also are just in an environment where markets have been up for the past few years, notwithstanding a little bit of volatility very recently, depending on quite when you're listening to the podcast. But markets on a whole are up quite a bit from when interest rates were rising and markets were starting to get much more volatile in 2022, which we would have picked up with our study that we did at the beginning of 2023. And so some combination of markets are up and work environments are more stabilized seems to be creating a pretty broad-based well-being lift across the whole advisor population.
Yeah, that's really interesting. Yeah, it does seem like, things have kind of stabilized in terms of what firms are going to be doing. And I think there was a chart in there about positive sentiment, and just curious, like, what were some of the changes that you found in positive sentiment from 2023 to 2025?
So we try to do a lot when we drill into these numbers of everything from asking more detailed questions about kind of what are the particular parts of your life or your sentiments that are feeling better or not better um, since the last time you did this study with us. And we also do a lot to segment different advisor sort of groups and subpopulations within advisors to understand what's shifting and what's changing. So as a general baseline, one of the most striking things that we found was that virtually every group of advisors experienced a very nice rebound in well-being since 2023, and nearly every group is higher now than it was 4 or 5 years ago. So advisors as a whole were up. Both men and women were improved in well-being across all of the racial diversity measurements that we have. Advisors were higher. Owners felt better. Employees were slightly lower than the past, but still rebounded from 2023. The most striking thing that we found, the one group that did not experience much of any rebound and is now a good bit lower in well-being than they were 4 or 5 years ago, are younger advisors. So we do this
Hmm.
literally by age, like advisors 18 to 34 years old, roughly speaking, Gen Z advisors in the marketplace today are rating lower on well-being and have had very little rebound over the past few years, as contrasted with older advisors, older by our data, are advisors in their 50s and 60s, where well-being is actually at record highs. In fact, we found across every segment of advisors that we measured, the happiest advisors were the oldest advisors and the unhappiest advisors were the youngest advisors. When we tried to drill in a little bit further to say, are there particular sentiments or parts of this that are shifting or impacting the scores, what we found is that the domains where advisors generally feel better were overall directionally, like what I do in life is valuable and worthwhile. We're all feeling the positive engagement from clients. It feels good to be an advisor and help people with their life challenges. We saw a significant lift in the activities I do. I feel organized, which again I think very much speaks to stabilization of work environments. The domains that we saw that were down, and particularly that were down amongst younger advisors, were in two primary spots. Sentiment around my life has a clear sense of purpose, and I
Hmm.
feel optimistic about my future. They were still both relatively high. They were not like in the dumps responses or anything, but both of these were a good bit lower than they were when we measured them in 2023. And notably, we found these declines particularly come in firms that have taken on outside ownership. So firms that have taken on PE and family office and institutional money and all the different combinations thereof. We are seeing a falling off in younger advisors feeling like their firms have less of a sense of purpose and less optimism about their future when outside ownership gets introduced. Notably, we're not seeing just like a wholesale decline in well-being for firms with outside ownership. On the whole, firms with outside ownership have very similar well-being levels to other firms. And in part, they also tend to be better run and better resourced because of the fact that they were appealing to a buyer and the influx of capital in the first place. But there does seem to be some, we kind of call like storm clouds on the horizon, at least, that younger firms and younger folks in firms that have taken on outside capital are having more questions about what this really means for them in their careers in the future. And that's showing up in lower well-being for younger advisors as a whole.
Yeah, I mean, I guess I wonder if you can dig into that a little bit because, we are seeing so much private equity money coming into this space, these minority investment shops, coming in as well. And, I guess, there's sometimes people, kind of either love it or they hate it. And it's like the big bad private equity is coming in and making all these changes and just flipping it over a short period of time. So I guess I'm wondering if you can speak to why do you think those younger advisors are that have that outside ownership feeling that dissatisfaction?
I mean, I'll hypothesize a little. We just found this, so we didn't ask follow up questions in our research because we didn't know at the time we were going to find it until we asked the initial questions and found it. So I'm gonna I guess I'll speak from anecdata, but not data in perspectives on this. The primary places we see this show up. The first is around optimism for the future, and I will say that I do think one of the challenges around PE investing into advisory firms is the kind of time horizon issues that you highlighted, Diana, right? PE firms often look in timeframes like 5 to 7 years, and advisors often look in timeframes like 30 years with my clients,
Mm.
which means if
Mhm.
I'm at this firm that just took on PE capital, by the time I retire, I might be on like the successor owner if our firm is going to be on a PE cycle. And that just creates a lot of uncertainty. Again, it doesn't necessarily mean things are going to actually be worse, because as I noted, on the whole, we find well-being scores are not significantly lower at PE-owned firms than the rest. But it does create a certain level of uncertainty, which we then see show up as demonstrably lower scores for optimism around future from advisors that are looking and saying, well, I thought I was going to be spending my career at the firm that I joined. Now the firm is PE owned or minority owned or majority owned. And I guess I'm just not really sure what kind of firm I'm going to be working for in 5, 10, 15, 20 years from now. All I know is it's almost definitely not going to be the PE firm that owns it today. So I don't really know where that's going. The second place I think where we potentially see this show up, look, as I joke sometimes, like PE firms are really good at making money with money. Like that's what they do. They make financial investments to grow enterprise value, to create a favorable exit, ideally for their investors and for the owners of the firm. And it is, although not universal, it is often the case these days that at least key advisor employees actually participate in that equity upside. Either they were owners in the prior firm and they participate in the growth, or they are equitized. They receive some equity opportunity when the PE event happens. And so it
Hmm.
can be wealth building for younger advisors, which is not necessarily a bad thing. But a lot of folks these days, we find in the research we do on overall motivators for advisors, most of us don't come to this career first and foremost for the income and the wealth opportunity. It happens to be a very remunerative career, and you can build a lot of financial success. But most of us come to this profession for some version of, I'm interested in money. I like to help people and be of service to others. And I love setting goals, achieving goals, and helping other people set their goals and achieve their goals. We're kind of goal oriented machines. And
Mhm.
so when you do this primarily from a focus of service to others and helping people achieve their goals, and it happens to be financially remunerative, the purpose set starts to change if the ownership says, well, building enterprise value is our primary focus around here now. I mean, yes, we want to serve clients well, because if the clients are not served well and leave, then you don't have much enterprise value. So clients don't disappear from that picture. But it does take on a different tone and a different connotation. And I think that is part of what we are seeing in these shifts, that the more outside ownership there is, the lower the scores we see on my life has a clear sense of purpose and I am optimistic about my future.
Yeah, that's great Great insight. I want to dig into like what the top drivers of happiness in 2025. I know that the report looks at 5 key drivers, and you've touched on some of them already. But what were sort of some of the top drivers of happiness this time around?
Yeah. So when we try to drill down what are the drivers of happiness, we just like for context, so for folks who are listening, our research team is a pair of PhD nerds. We say that affectionately. I am the chief financial planning nerd. That's a term of endearment in our organization. But we have a couple of PhD nerds whose job is to bring all of the academic rigor of research to the data analysis that we do. And what that means is we actually take a very wide range of things that we measure in our well-being study, put them into the proverbial variable blender, and really try to suss out what truly are the underlying drivers that impact happiness and well-being of advisors, not just proximally things like older advisors tend to be happier, but to drill and say, well, why are older advisors happier? Like, are they happier because they're more likely to be owners? Because that is true by timeline. Are they happier because they have a different type of clientele? Are they happier because of their earnings? Are they happier because of the type of firm that they structured for themselves? Like, there's a lot of different things that can go into why it happens to show up that older advisors are happier on average than younger advisors. So we try to decompose all of that to get to like truly the underlying things that seem to filter through all the different dimensions that really drive well-being outcomes. So as you mentioned, Diana, there were 5 that showed up, a few sort of more impactful or more controllable than others. The first that kind of comes together with a little bit of a pairing is that advisors tend to be much happier when they're more experienced and they have
Hmm.
more autonomy.
Hmm.
Experience is pretty much just what it says. We find there's a remarkably consistent, straightforward line to be drawn that the more years of experience an advisor has, the happier they tend to be in their advisory firms. I think this is just lots of different things compound as with experience as an advisor. Your confidence grows, your skills grow in communicating and managing clients, your technical knowledge grows as you get in more repetitions in various client situations. Your brand grows as you get known in your community, which tends to make growth a little bit easier. Your relationships get deeper because you've just literally had clients that have been around for 5 or 10 or 15 or 20 years, depending on how long you've been doing this when your clients started. And so experience is a remarkably strong predictor of well-being. Not necessarily the best news for younger, newer advisors who don't have the experience yet. Beyond reflecting back, it really does get better. Like if you can survive and run the early stages of the marathon, because this profession is very much a marathon, not a sprint, it really does get better because almost all the things that matter and drive outcomes for advisors are things that compound with experience and time. The second part that we find that goes with this is that the more autonomy advisors have, the more control they have over their own situations, the happier they tend to be as well. I think, Diana, in part, this is why you still see so much movement in the industry as a whole towards independent channels. It's not really necessarily about independence per se. It's about autonomy. Like it's just about the advisor being in a place where when they have been doing it for a while and say, I know what my clients need and how they should be served, and I want to serve them the way that they want to be served. If I'm in a firm that lets me work with who I want, the way that I want, charge what I want, and serve my clients well, I tend to be happier. And if I work in a firm that doesn't have the tech, doesn't have the resources, won't let me do the things, compliance is blocking me from doing what I think is best for my clients, I tend to get really frustrated very quickly. Kind of related to that, aside from the general overarching autonomy, we find that there is a lot of well-being that is driven by being in a workplace, being in a firm that we're happy with. This shows up with a lot of different subdimensions: quality of the firm's tech stack, how flexible they are about work from home versus work in the office. In general, we find advisors tend to be happier if there is at least some flexibility about home versus office, unless you're just a really hardcore, I must be 100% home or I must be 100% office. flexible work policies, having some kind of team support so that I don't have to spend so much time on compliance and admin, and having paths to equity, having paths to partnership all show up as factors that contribute to being in a positive workplace. The last notable part that I will highlight here about what drives greater well-being outcomes for advisors is how well we're compensated, not on a total income basis, but if you break down, in essence, how much revenue I earn for how many hours I work, whether that adds up to a good number. Advisors who can command a good value for their time tend to be a lot happier than those who are working lots of hours with lots of clients and don't have a lot of revenue to show for it. So we'll see this everything from the advisor that has a focused clientele of like 50 high net worth clients. They make a great income. And because they've got 50 clients, they don't even work a full-time 40 hours a week. They work fewer hours. So they bring their income down a little, but they're making a great income for every hour they're actually working. To the subset of advisors who love the work and what they do, and they work 45 or 50 plus hours a week, but they're charging full valued fees and it's very remunerative, and they want to work a little bit harder and work more hours, and they're able to reflect that in more income that they take home. So it's not necessarily generating higher income in total, but it's about generating a strong revenue for the hours that you're working. And what that means very, very practically and quickly is actually having a proper fee schedule so you're really getting paid for your time, having appropriate minimums so you're not giving away too much work to clients who really can't actually afford to pay you what you're worth for the value that you're creating. Those tend to be very big drivers. And it's fascinating to us because most of us as advisors really struggle with things like setting minimums because it doesn't feel great to have to tell certain clients, no, I can't work with you or you can't afford to work with me. But what we see empirically very clear in the data is advisors who manage to navigate that hump and get to the other side where they're really being well compensated appropriately for all the work that they're doing tend to be much, much happier on the other side of that.
Yeah, I mean, this is really great because, we see so much of these benchmark studies, that are talking about, all these types of business practices that advisors can put in place and what some of their peers are doing. But I mean, this is really like, what are the business practices that are making your peers happy or unhappy, And so this is really, I think this would be really helpful for listeners in terms of maybe you should try that and maybe, you'll be happier. And, this is a 52-page report that you guys have put out. It does go really deep into some of these
Yeah,
issues.
there's lots more than what we can cover
I mean,
in
we're just
limited
scratching
time.
the surface.
Yeah.
Yeah. And I don't want to stop, but I was just looking at this one chart that I thought was really interesting. It's, the motivational differences between struggling advisors, which are those who have low well-being scores, and thriving advisors who have the highest scores. And those that are thriving value the desire to work with people. Work-life balance is important,
Yep.
more so than the other group. They have an interest in investments. But for the struggling group, the income potential was more important. And it was still important for the thriving group, but not as important as the struggling group, which I thought was interesting.
Yeah,
Um,
we see
yeah, go
that
ahead, Michael.
finding ripple through a number of spots throughout our research and have for years on in the context of well-being. I mean, so much so that one of the indirect drivers that we found in predicting well-being was one that we basically just dubbed having enough and being clear about what enough is. There's a fundamental challenge for people who pursue a career for income potential, which is it's a race you can never really win. It's a path that doesn't have an end. It's a goal without an end point, right? I mean, if the goal is I want to earn more, you never end that journey. You say someday it would be cool to have $10 million under management. And then you get to 10 and you say 20. And then you get to 20 million, say 50. And then you get to 50 million, say 100. And then it's 200. And then it's 500. And then it's a billion. And then it's several billion. And then you take on PE money and you try to make it 10 or 20 or 30 billion. And, not that it's bad to grow and scale up an enterprise, but if the driver is, oh, if I could just grow a little bit more, I would finally be happy. What we find is for the folks that are wired that way, they never get to that destination. And the advisors who at some point say, it's good and it's good enough, I'm earning enough, not to say that they stop growing necessarily, but the motivator, the driver is no longer about lifting income potential. It starts to morph into other things, serving others, serving clients, work with people, develop my team. When advisors can find a way to reset the goals to something else, well-being tends to lift. And if we stay on the just trying to earn more income wagon, it can be very financially remunerative. The compounding doesn't even necessarily really have to stop if you want to just keep growing it bigger. But we find that the well-being doesn't really keep going up. We're just working harder and harder to try to make more money without necessarily being clear about what that's serving in our lives. And there's probably a bigger meta commentary about that in America as a whole and our sort of individualism in pursuit of goals. But we really do see it show up in the research that there is a point early on where continuing to grow the practice and grow income lifts well-being very directly. When we're no longer when we're trying to get out of the financially struggling phase. And then there's a point where it stops being a lift and it doesn't really help well-being anymore beyond that point.
Yeah, I think that this is also important for just wealth management firms and companies in this space in general, because there's a strong link between well-being and turnover and
Yes.
well-being and business performance as well. And so I'm wondering, like, given everything that you know about well-being, everything that you've studied, what can firms do to better support advisor well-being and, reduce that turnover and burnout?
Yeah, it's a good question. Because look, I mean, to make that link, they really are connected together. As you noted, we sort of segment advisors in our research into three groups. Those are those who are thriving, very high well-being, those who are struggling, very low well-being, and then there's kind of a group in the middle that are just sort of average middle of the pack. And amongst thriving advisors, turnover rate is basically 1%. I mean,
Mm.
it's almost non-existent. When we get to struggling advisors, its turnover rate is 9% in a year and 13% who plan to leave their firms within 5 years, most of whom are just going to get out in a year. They can't even wait that long. So that's not big. I mean, you're literally talking about a roughly 10x difference in turnover rate. And for most firms, like turning over advisors turns over clients because clients often leave or follow when advisors depart. So this stuff really does matter. If you are a firm owner that wants to hold on your advisors and your clients, like solving for their well-being really matters. So to your question, Diana, like what shows up there? So when we put all of it together and we look at like what can firms do that create those opportunity outcomes or improve well-being retention. So number one, staff support for your advisors is one of the biggest drivers. As advisors, I mean, this isn't news to anyone, but we really don't like doing admin, compliance, servicing paperwork. The sooner advisory firms can get that off their advisors' plates with staff and team support, the more well-being lifts. Notably, the more productivity lifts as well. So this is actually a very positive ROI for the firm in many ways. But I highlight it because we still see a lot of firms that struggle to hire and retain admin staff. And because they struggle to hire and retain admin staff, they don't put a lot of staff support in place for their advisors. And then their advisors end up being very frustrated because they're doing too much of the admin and paperwork themselves that they don't want to do, but they have no one to delegate it to. From the advisor end, the corollary I would add to that is this is why ultimately it becomes so important to set effective fees and minimums and earn enough revenue per hour in the work that you're doing with clients as an advisor. It's not just about lifting your own income by, trying to charge effectively with clients. It's that if you don't set your fees and your minimums effectively, you won't have enough revenue to afford the staff support you need to have a client service administrator and an associate advisor to delegate to. If you're doing everything yourself for all your clients, there is a ceiling where you're just going to hit absolute capacity of all the hours you can work doing all the work you do for clients, above which you cannot grow your revenue anymore because you're just literally out of time. There's also a floor that you have to get to in order to be able to afford staff support. Otherwise, you're going to hire staff and it's going to cost you so much as a percentage of your revenue that you'll be making less than your admin staff. And so if you kind of think of these together, there's a ceiling on revenue based on capacity, and there's a floor of revenue you need to get to hire a team. If your capacity ceiling is below your hiring floor, you are stuck in a trap you can't get out of. You cannot grow your revenue enough to hire support, and you cannot grow your revenue without support. And the only way that you unhinge and solve for that is to fix your fees and set minimums so that you are actually generating enough revenue to cover the time it takes to do the work and to cover the time and to generate the revenue it takes to hire the staff members, the team members, to expand the work capacity of the team. So for advisors, it's very much about making sure your fees are at a point that can actually support team infrastructure. And for firms, it's using their revenue to actually invest into the support infrastructure. Most of what comes thereafter is downstream. As mentioned earlier, flexibility and autonomy tends to go over well. So as a general note for firms, not really news, but the less onerous you can make compliance, the more flexibility you can give advisors about their work environments, the better it tends to go. The one other thing I think that I would highlight to this, Diana, is around the technology part in particular.
Yeah.
Because when you look at both our well-being research and we also do a productivity study every other year as well, one of the most striking things that we find around the role and impact of technology in firms is technology is one of the biggest drivers of workplace satisfaction. So workplace is one of the big drivers of 5 things that makes advisors happier in their firms overall. And tech is a huge driver of workplace well-being. It is not, however, a very large driver of productivity itself. We actually do not see lifts in productivity measuring things like revenue per advisor at firms that have superior technology, more tech sophistication, more integration of their systems. Because at the end of the day, if advisors can save a few minutes with their tech by having really good tech, most of them don't go and take another client meeting to add more revenue. They just go home a little earlier and a little happier.
Yeah.
Because they didn't have to use that piece of tech that's driving them bonkers all days. The part that lifts productivity is staff infrastructure, team members, people to delegate things to. If I have lots of tech to make me really fast, the good news is I'm fast. The bad news is I have to log into 17 pieces of software to use it, and it drives me nuts. When I have a team, I'll log into 17 pieces of software. My team uses the software. I see clients, and I work with my team. And so what we find is when it comes to technology, great tech to make the advisor's day-to-day life better is a huge lift, but it's not necessarily a productivity lift, it's a retention lift. If you actually want to try to move the productivity level, it's much more a matter of getting advisors the staff and team support so that they can actually delegate and really increase their capacity.
Yeah, this is really great stuff. I want to get a little personal, Michael, if you would,
Sure.
to sort of end things here, because, I've got a lot of people come on and talk about their own personal struggles. Was there some kind of personal experience or struggle that you had as an advisor or professional in general that inspired you to study well-being?
I mean, I feel like I lived all the parts of the study that we've kind of talked about here all along the way. How awful it was early on in the initial years. I think that was kind of scarring to me. I feel like that's scarring to most of us as advisors to live just the brutal early years, particularly if you've been in like 20 plus years as I have, where we started before the do not call list, which meant like cold calling. Cold calling was the deal unless you were really personal and outgoing. And then you could choose to cold knock instead of cold call if you wanted to do it in person. Those were your choices. Valuing autonomy as someone that ultimately went out and hung their own shingle to build not one, but several businesses over the years, and having the flexibility to choose what you're going to build. I was very deliberate and intentional about companies that I built over the years, a period of about a decade when my kids were young, when I kept the business much smaller to support my lifestyle and my work-life balance. And then the shifts that I've made as the kids got a little bit older to say, now I'm ready to actually build this bigger.
Mm.
And the way that priorities start to shift once you do get past the point where, okay, I'm earning enough from my practice that I'm no longer in the sort of like financial desperation. I just need to make sure I earn enough money to put food on the table and a roof over my family's head. And we get to, okay, I'm pretty confident that all of my family goals are going to be achieved. Like we have a place to live. The kids are going to be able to go to college, or we're going to be able to retire. Now what? And watching the goals and the priorities change. Like I very much have lived that journey myself. As you mentioned, Diana, we have a podcast called Financial Advisor Success, where we invite stories of advisors coming on and telling their journeys as well. And we see the same thing. Like that word success means different things for different people. For a lot of us, it actually changes over time as we go through stages of career and seasons of life. And so from my end, I feel like I've lived a lot of that well-being journey, which is, there was a survival phase. There was a phase of balancing work and trying to build something with young children and being available for my family. And now there's been a phase of, okay, I'm pretty sure my goals are gonna be okay. This has really now become something that's much more about reach and impact, and what we can do to move the whole financial planning profession forward
Mm.
using the platform that we built, and now some of the research that we can do to try to get to the heart of, okay, there's lots of like platitudes out there, but really truly when you get into the data, what moves the needle, whether it's marketing, technology, well-being, productivity. We've got studies on all of those, but trying to really get to the heart of the matter to understand what's driving these outcomes. And what we find as we get into it is it's not always the things that people say offhand that are the ones that actually matter.
Yeah, well, I mean, as a journalist, we love that. We hate platitudes, and I've definitely covered some of your research, and it's very valuable and very just really digging into the data and what does this mean for the advisor's business and for the industry. And so it's very valuable stuff. Well, I'm afraid we're just about out of time, but I'd like to thank my guest, Michael Kitces, for being
Really?
on the podcast and just sharing some great insights from Kitces Advisor Wellbeing Study. Michael, thank you so much.
Absolutely. My pleasure. Thank you.
And if you'd like to reach out to Michael, you can reach him at questions@kitces.com. And the study is at kitces.com/wellbeing. And if you yourself have a struggle, you wish to share your experiences and help others in similar situations, please feel free to reach out to me at diana.britton@informa.com. I'd like to thank you for listening to The Healthy Advisor. If you've not subscribed to the podcast yet, please click the subscribe now button below. This is Diana Britton reminding you that where there's healing, there is hope. We'll see you next time. Thank you for listening to The Healthy Advisor, a podcast focused on advisors' personal well-being and healing. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of wealthmanagement.com. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional advice. Always seek the advice of your healthcare provider with any questions you may have regarding your particular situation.